So let's have a look at a typical hedge fund structure, a hedge fund example of what might happen in a typical year. So let's say they're holding $100 million of investor money as assets under management, and they've got 50 positions, 25 long, 25 short. And they have a self-imposed position limit, so no position can be bigger than 2% in the portfolio. So nothing can be over $2 million. That's a very diverse hedge fund. They're not taking a great deal of risk. But let's say last year they made a 20% return on a portfolio with mid-teens volatility. That's a good hedge fund. If they're diverse that much, they make 20%, and they get and it's on mid-teens volatility, they're doing really well. They've had a good year. They charge a 2% management fee based on the AUM at the beginning of the year. So the onshore management company takes $2 million of fees and $4 million performance in that situation. But $2 million of that $4 million is reinvested. So what happens? It's pretty obvious. They don't get paid a performance fee if they lose money. They get the management fee. So first of all, what does the management fee actually do? What's it for? Anyone take a guess? Exactly. The onshore management fee goes to pay for all of the infrastructure of the fund, including basic salaries of everybody in the office. That's the first thing. All professional traders have a basic salary, and so do hedge fund managers. But what about the performance when they have a bad year? They don't get paid. In a good year, what do? They reinvest their money into the fund. So the fund grows. So what do retail traders have to do if they're trying to emulate successful hedge fund managers? Reinvest their money. So when they make money, they take more risk. When they lose money, they don't increase their exposure. It's pretty obvious, no? So why do retail traders do the total opposite? Huh?
They want to secure their profits.
Secure their profits?
They don't want to lose them again.
Yeah, so they're taking their money out of their trading account. That's a typical behavior, yeah? The holy grail for a hedge fund manager is to grow the fund, let's say from 100 million in year 1 to 5 billion in year 6. And a standard industry metric is applied to sell the hedge fund. There'll be a value to the fund because they've got 5 billion of assets under management. Does anybody know what it is? The standard industry metric for asset managers and hedge funds? It's 1/10 of assets under management. So they'll sell that fund for 500 million. And they'll have their own money in the fund the whole time and be increasing their holding the whole time. So they grow that from 100 to 5 billion and walk away with 500 million. That's a successful hedge fund manager. So you should really be taking a few messages from this. You know, if your objective here is to make money, which it is, no one goes into the market to lose money. We all go in with the idea that we're going to become superstars and make loads of money. So the objective here is to make money using our own money. So out of this, retail traders should take several really important messages. Hedge fund managers use their own money and accept outside investor money. Investment bank traders don't. So what does that mean? For a retail trader, your objective is a hell of a lot more aligned with that of a hedge fund manager. The prop function and hedge fund managers, they both hold long, short, diverse portfolios with a fairly medium-term to long-term time horizon, obviously depending on what company you work for and what the investment mandate is. They both get paid a basic salary. That's really important. So many retail traders think trading is for income. It isn't. People must have seen it before where you get the message, you get the emails. You can make $10,000 a month trading the international forex markets. So people do it. They open a trading account, 100 grand. In month one, they make 10 grand. They take out the 10 grand. They spend it. In month two, they lose 10 grand. Then they take 10 grand out, and they're left with 80, and they spend 10 grand. So what are they doing? When they make money, they're taking money out of their trading account. When they lose money, they're taking more risk. They're doing the total opposite to what professional traders do. You should never, ever, ever, as a retail trader, take an income from your trading account. It's not an income strategy. If you want an income strategy, buy a bunch of stocks and hold them for a decade that pay a 4% dividend yield. Go and buy a flat and rent it out to somebody. That'll pay you an income. Go and buy a government bond. That'll pay you a coupon. Trading is not for income. Every professional trader knows that. That's why they charge a management fee, so they can get paid a basic salary. And the industry is very, very competitive. It's so competitive in the hedge fund industry, people going and pitching high net worth in institutions for a limited amount of capital. It's so competitive that all of them still ask for a management fee. So why do we think they do that? Because they know that trading is not for income. Their objective is to grow their account to as big as possible so they can sell the fund. So they don't want to take any money out of the fund. They want to reinvest it as much as they can because they want an exit for as big as possible, as quickly as possible. Does that make sense? So hedge fund managers are literally doing the total opposite to what most retail traders do. When they make money, reinvest. Lose money, don't increase your risk. So let's go through some of the main differences. We have touched on some of them already. Differences between professional traders and retail traders. So if you're going to compare yourself or try to emulate the best and most successful professional traders, you've got to emulate their strategies. And from a very basic level, we've been through some of them. You've got to have a basic salary doing something else to begin with. Otherwise, you're just not going to grow your account because you'll be forced to take an income from your trading account. And it'll be terminal. You'll just go to zero, either very quickly or slowly. But you will be at zero at some point if you do that. And the principle of taking more risk when you make money and taking less risk when you lose money. From the ground up, that's pretty basic stuff, but millions of people get it wrong every year. And it's repeat and rinse. Every year, same approach, go to zero, start again. Put 10 grand in your trading account, lose it, go to zero. 6 months later, start again with another 10 grand, do it again. No one ever learns.